Welcome to the AMI Investment Third Quarter Update. Before we get started, a brief disclosure on your screen. Looking at a recap, moving on, we've got our assets under advisement as we stand today, just to give you an idea of where we are. Total firm AUM 1.9 billion plus another roughly 435 million in model-based platforms. We also have a large cap growth equity income strategy, and we have a small cap growth strategy, as well as a small portion of fixed income managed by a different team than we have today on the call. A little bit of a market outlook. We're doing things a little bit different this quarter, but I want to start off with an outlook. S&P 500 extended the rally. A lot of AI enthusiasm was driving the gains. Index was up roughly 8% in the third quarter. It is up roughly 15% year to date. Markets have largely ignored a lot of the softening economic data that we've seen, and the Fed cut rates in September. We still see a lot of slowdown underneath the surface, employment getting softer, consumer spending, particularly at the low end, under pressure. And now we've got the federal government shutdown. So that adds another wrinkle. Inflation, Federal Reserve outlook, inflation continues still elevated, but getting slightly better. So less of a concern for the Fed, we think, and gives them free rein to cut here this week. I'm going to hand it over to Andy to talk about some of the AI investment that's been going on.
Yeah, so we had Q2 GDP print at just under 4%, so 3.8. And if you peel it back a little bit, you can see a lot of that growth and a lot of the strength there, because it's a pretty good number, was almost entirely AI driven. So I'm sure a lot of people listening have heard a lot about AI, but what's really happening is all this capital expenditure, both from the hyperscalers and others, is really what's driving a lot of the investment portion of GDP. And for the first time ever, we saw that AI infrastructure spend surpass consumer spending. We've always heard that consumer spending is like the number one piece of GDP, and so goes the consumer, so goes the economy. Well, seemingly that's switching to AI investment. So, and if you back it out, if you back out the AI investment, U.S. GDP growth was really positive, according to some people here. This Jason Furman stat, you see, it says the U.S. GDP growth will have been 0.1%. We've heard different numbers, but you can kind of see order of magnitude how much AI is driving things. And, that's fed its way into the market, the equity market. So since late 2022, when ChatGPT first came on the scene, anything linked to AI has been going up. So 80% of S&P earnings growth and 90% of that CapEx growth I just talked about were linked to AI-related investments in companies. The Mag 7 is now over a third of the S&P's market cap. We have market concentration risks that have bubbled up here. And it's the AI mania, if you will, is really what's been fueling investor optimism in the broader stock market. So companies like Oracle, NVIDIA, and OpenAI formed an investment and chip supply agreement. We saw all the stocks of Oracle and NVIDIA just skyrocket, just on news. And that comes with some risk, obviously, when if some of that investment or some of those revenues don't come to pass. And so we have some questions about true end user demand. A lot of the circular spending, we have NVIDIA investing in one company, and that company is taking that money and putting it to something else. All of which is generating comparisons to the 2000 tech bubble, as we're seeing sort of valuations start to get a little bit stretched, breadth narrowing, concentration increasing. And so it's really been a really big driving factor of what's happened here in the market in Q3.
Looking at the overall strategy, just to remind folks about what we do here, pretty straightforward GARP strategy, trying to identify high quality growing companies. We do invest in companies more heavily with recurring revenue business models, and we define that as a company whose product or service has a lifespan of less than 2 years. We do run concentrated portfolios, 30 to 35 positions, lower turnover, for roughly 25% on average for the large cap strategies, and about double that, around 50% for the small cap. We also target lower standard deviation and downside capture versus the universe. So this is a large cap growth, our flagship strategy, performance in the down markets that we've seen going back to 2000. You can see here on the right-hand side, quite a bit of alpha. Looking at the returns, so for this latest quarter, as well as all the various long-term annualized returns, we like to point folks to certainly to the far right, inception. We've got lots of stuff that happened in that time frame. We've managed to outperform both the S&P 500 and the Russell 1000 Growth Index over that time frame, with just lots of craziness in there. But certainly this most recent quarter, a little bit more challenging, as Andy mentioned, really driven by the AI headwinds. From a attribution standpoint versus the Russell 1000 Growth, you can see we did underperform here, about a third of that being due to allocation, and most of that our overweight position in consumer staples, but also security selection. Now, a lot of that does fall to information technology, which again is really being skewed by NVIDIA, the largest company in that space, which effectively raises the bar for just about everything. Pretty similar numbers for the S&P 500. Really, the only major difference there is some of the allocation effect. And with this, I'm going to turn you over to Andy and Richard to talk about what the top and bottom contributors were for the third quarter.
Yeah, so the top name there, Alphabet or Google, had a good quarter. So what had been hanging over the stock for quite a while was this federal judge was set to rule. We didn't know when exactly when it would come, but basically there was an antitrust suit saying that Google may or may not have to spin off things like Chrome, their very popular web browser. There was talk about the payments that they make to Apple to be the default search engine on the iPhone. All of that was up in the air. No one knew how it was going to pan out. A lot of big dollars involved. Turned out during the quarter that the judge's ruling was not as draconian in terms of the remedies. So yes, the payments didn't necessarily have to stop, but they couldn't be exclusive. They did not have to spin off or sell Chrome. Things like data collection, there was some nuance there. So basically, it was all Google could continue as they've been doing with just some minor edits to how they do business. So that helped Google. It also helped Apple because Apple was a beneficiary of some of these payments. So Google had that overhang lifted. Plus, they had strong earnings during the quarter. Their AI monetization efforts for what they have the for their cloud division was going really well. They saw sharp acceleration. So pretty good quarter from the company. Apple, on their hands, they have the benefit of these Google payments not going away. They also beat estimates. iPhone sales surged, which I think was a surprise. Some folks thought that perhaps it was going to be a weak quarter because Apple Intelligence hadn't really become the thing that people had hoped would drive a big super cycle. Some of that, now in fairness, was pulled forward from the tariff issue, if you recall, from way back in April. So there was that dynamic in there that a lot of future Apple iPhone purchases might have been pulled forward. But the new iPhone 17, which got announced, I think was driving just overall optimism that people would eventually upgrade. Broadcom, another beneficiary of the AI trade. So their shares did really well during the quarter. Strong earnings. People, they're in a variety of businesses. They have a huge software division. They're in not just AI data centers. They're in things like auto, what they call Internet of Things, which is basically everything else that's connected to the internet other than a GPU or a car, if you will. That did well. But what really spiked the shares after they reported was that they said that they had a new what they called hyperscale customer. Now, at the time, people thought that was OpenAI. Turned out several months later, we found out that it wasn't OpenAI. They announced a different deal with OpenAI, so that was incremental, but ended up being Anthropic, the maker of the Cloud chatbot. Everyone's seemingly looking to go towards what they call custom GPUs or ASICs, or they call them XPUs, and they're supposedly supposed to do what NVIDIA or AMD's GPUs do, but more efficient on the power side. They can be more specialized, and Broadcom is seeing a lot of big orders because of that. So that stock did well. And then Taiwan Semi, they really make all this stuff. So all these companies you hear about, whether it's NVIDIA, AMD, Broadcom, Alphabet has their own chips that they're making. They all use Taiwan Semi, and that's for the simple reason that no one else can do what they do. So regardless of who wins that battle, Taiwan Semi seems to be getting all the orders. Capacity is completely used up and full. So they've got momentum going into the fourth quarter. They recently announced earnings, and as expected, things growth was pretty strong, but they didn't signal that anything was slowing. If anything, they said the opposite, that they thought things were actually doing even better. So any kind of fears that AI spend was going to slow or wane kind of went away, and Taiwan Semi was the beneficiary of that. Now, on the other side of the coin, on the bottom contributors, I'll touch on a few of the names there. So, two of them are in the software space, and software has had its share of issues in terms of AI. ServiceNow, so there was some slight deceleration in their subscription revenue growth. ServiceNow is doing a lot of what they call um, agent related software, meaning they take a business process, whether it's doing stuff with your vendors or customers, and automating all of that. So they're in within the slice of software where you want to be. They're kind of one of the best companies doing what they do. Now that said, things did slow because the mind share right now of a lot of enterprises is really on the hardware side. Everyone's racing to get their models developed, their own infrastructure in place, data center capacity. Software's taking a back seat, at least for now. But we still like what they're doing. We think agentic software is going to replace a lot of processes, and really, eventually, these applications would sit on top of all this infrastructure that's going into the ground or into the data center. Is really what's going to drive efficiencies for companies that are deploying AI. Similar story with Salesforce. They had a disappointing guide because of some of the same reasons. Now, subsequent to their report, and this was after the quarter, they talked also about agentic software and some of the automation they're doing and how that's going to start to reaccelerate things going forward as we get into the outer years. So we continue to like that stock. Netflix, that was more of a pullback, really, as the entire comm services sector pulled back. They had a really strong year going into the third quarter. Stock was up a lot, as was the whole sector for the most part. And metrics were strong, financials were good. It was just more of a pullback from highs than anything wrong with the company. Their Q4 slate's looking strong. This wasn't in Q3, but they had some issue with like a Brazilian tax thing. So just a lot of noise around the company in the quarter and the weeks after, but we still like it. Financials are really strong, um, and we continue to think that's going to be one of the better companies in streaming as they continue to take share versus legacy media. With that, I'll pass it back to Richard to go over his names.
Yeah, so Ulta Beauty had a very nice quarter, meaningfully beating comp and earnings estimates. The beauty category is one of the most resilient in consumer discretionary, which is seeing underlying spending kind of weak overall, but beauty remains pretty strong. Ulta's executing well and taking market share in an attractive category. And then the bottom performers, Church and Dwight and Colgate Palmolive, both players in the household and personal care space. So Church and Dwight is having some issues with their vitamin business. It's declining. There's a lot of competition. It's sort of overshadowing solid market share gains in their core laundry business as consumers trade down to more value-focused laundry. Colgate, the categories have been pretty weak. Colgate is obviously a leader in toothpaste and manual toothbrushes. They pointed their organic sales growth guidance to the low end of the initial range that they put out there, largely due to sort of weak underlying spending. We continue to like both of those companies. Both are quite defensive, both daily use products. You have to wash your clothes and you have to brush your teeth. So we think that that growth there is set to accelerate, and it was just really not a great quarter for sort of boring, more defensive businesses like those two.
I'll touch on some new names that we added in our name that left the large cap strategy. So first up, Spotify. I'm sure a lot of people um, know it or use it, but leading global music and audio streaming platform. What we like about the company is, one, especially this year when there's a lot of geopolitical tariff-led issues, they're kind of immune from that. Um, we obviously like the strength of their breadth of product, um, and it's a highly predictable business. They have really strong pricing power, so whenever they push through a price increase, very little of any churn from that. They have some new businesses that are getting into that can help grow the company, things like podcasts and audiobooks. They also have this way of customer acquisition that's actually relatively inexpensive for them. So they have this a freemium model, so they have an ad-supported tier um, that draws folks in, but you can't really, it's somewhat limiting. You can't fast forward or switch things, and there's commercial breaks. And then what people end up doing is they end up paying for it because they want to get rid of the ads. So they acquire customers just by having pretty much every artist that's out there. Plus now they have these new things like books and podcasts. So we like this company a lot. It's got some defensive characteristics. It's almost like a tech staple, if you will. Um, the pricing power is very strong, and we think there's a lot of white space for them to move into other markets and other new areas with their huge customer base. CrowdStrike, another new name. So they are one of the top cybersecurity companies. What they do is they protect pretty much anything you do online or what enterprises need to do online. And what really drove us to the company this quarter was with the growth of AI and if you remember what I just talked about, agentic software. These are computers talking to other computers, and what's become a challenge for executives is how to make sure that when computers are talking to other computers, that it's managed. So it's not just like protecting passwords, some of the old way of securing your network, but really just making sure that when these software agents or AI bots are communicating or accessing files within your system, nothing's leaving that's not meant to leave. So it's two things: protecting data from leaving your enterprise without authorization, but also protecting against the more traditional um, bad actors that might use AI to sort of hack into a network and things of that nature. So very strong, and they're cloud native. So unlike some other companies that were born with sort of like in the mid 90s, if you will, where things were on premise and then they eventually moved to the cloud, CrowdStrike was sort of born in the cloud. So all of their entire product suite is what they call cloud native, and it just easily flows into one's workflows and can integrate into your existing systems. So we like the growth there. It's highly recurring, and again, it's one of those budget items that's you're really not going to touch because you can't really afford to have your networks be compromised. There's one more. So Snowflake. Um, this is, I guess, technically a software company, but they're unique in that um, they're managed the data that is gathered by enterprises. So let's just say you're like a Workday, for example, or you're a company that uses Workday or one of these other big SaaS companies. You have all this data. You have your HR data, your financial data, anything, customer data, your vendor data. All of that needs to be managed to be able to be used. And what makes AI useful, so you have all these companies spending on AI, unless you can like sort the data and manage it effectively, the data is somewhat worthless, and therefore what AI spits out is not going to be very useful. So Snowflake's what they call their AI data cloud is again highly recurring because you're paying for it on a recurring basis. Um, and it's just a crucial infrastructure player for AI adoption. So the more AI you deploy, the more you need databases and organization of data and way to manipulate that data. Otherwise, you can't really use the AI that you're spending on. So they become pretty critical. There's only like one or two companies that do this. Snowflake's by far one of the best or leading. And so we really like that as a sort of a recurring way to play the all this huge hardware investment that's taking place. We did have one sale during the quarter, which was CyberArk. They were an IT security company, and they actually got sold to Palo Alto Networks, which is also an AMI holding that's in the identity security space. And that was it for me on the quarter. I'll let Richard talk about Maple Bear.
Yeah, so Maple Bear doing business as Instacart, clear leader in third-party grocery delivery, has almost half of the market there. Grocery delivery is very underpenetrated, but is really growing nicely. And Instacart has a very sticky business with their grocery retail customers, where, not only do they provide sort of customer-facing delivery of grocery, they also provide, real-time inventory management and software services that power grocery retail branded delivery as well. So, there's a lot to like there. It's a nice growth business within a traditionally defensive category, which I think is something that we like, and a stock that's still, attractively valued for, kind of all the growth white space that's out there for them. We bought that as a replacement for Constellation Brands. They've been struggling now for a little while. The Hispanic consumer base, which is about half of their consumer base here in the U.S., is having some macroeconomic headwinds in terms of employment, in terms of immigration policy. There's no real end in sight to these kinds of issues, and as a result, we just decided that there were better growth opportunities elsewhere within the consumer staple space.
Looking at the large cap sector ways, you can see here the real one glaring difference is going to be in tech. We like tech to the tune of 34%, not the north of 50% that the Russell 1000 growth is sitting at. These weights don't change very much dramatically, so we've typically been overweight healthcare and consumer staples due to the area that we can find recurring revenue the easiest. Portfolio here at the end of the quarter. Certainly, if any of these names pique your interest, you want to talk about them specifically, do deep dives, feel free to reach out to us. Shifting over to small cap, a little bit different dynamic there. We did have outperformance mainly due to healthcare, as you can see here in the attribution versus the 2000 growth ETF. Healthcare was the significant driver. We've just had a lot of success finding small, emerging biotech type of names that don't have huge binary risk from phase one, phase two type trials. These are companies that have already successfully completed phase three and are launching products into the market. Infotech, a headwind there. Again, kind of a weird dynamic where there are a handful of, call them quantum and AI plays that are not true small caps, that are well north of 10 billion market cap and have been driving that sector for some time now. From a contribution, CG Oncology, this is a company that has a new type of treatment for bladder cancer. They will be filing with the FDA here shortly. We expect to launch about midway through next year. The bladder cancer space we think is going to be dominated by two companies, CG as well as Johnson & Johnson, which just got their approval about a month ago. And so these are really highly efficacious type of treatments that are allowing people to, forego major bladder surgeries. Madrigal Pharmaceuticals is the only, up until recently, the only company with a drug to treat MASH, which stands for metabolic associated steatohepatitis, so basically fatty liver disease. They launched a little more than a year ago and have had just great success growing significantly into that space. Do have some competition from the GLPs, which was Ozempic was just approved in that space, but we think it's a more efficacious drug and very tolerable with a low side effect profile. Arcutis Biotherapeutics is one of the newest launch of a topical skincare for several different disease states: psoriasis, eczema, and seborrheic dermatitis. And so this is an alternative to topical steroids, which aren't great for long-term use. And so they've had some great success there. We think they'll continue to grow nicely. Kenexa is a supplier of a treatment, the only approved treatment for pericarditis. So this is inflammation of the sac surrounding the heart. They've had just great success there, continue to grow nicely, and should be gone from in rapid form from unprofitable to quite profitable here this year. So continue to be bullish on that name. On the bottom contributor side, Merit Medical, a medical device company, a little bit more of the steady Eddie type of grower. They saw a little bit of impact from tariffs earlier this year, which weighed on the stock to some degree, but manageable, we think. But they did get an adverse ruling on their newest launch for a type of basically a vein support product for dialysis, and they didn't get an add-on payment that they were expecting. So we think that may impact uptake of the product, but we'll see. They're just barely launching. It's more of a 26, 27 type of product. So we'll see how that plays out. But that was some negative sentiment. Upstart Holding, new name that just entered the portfolio right out of the gate, was somewhat weak with some of the other, call it fintech names. And I'll dive into that here a little bit more shortly. And I'll hand it back over to Andre to discuss Primoris.
Yeah, Primoris is in the top performers. It's our infrastructure builder. This is one of the companies that benefited the most from the CapEx super cycle that we are seeing, that we're experiencing from AI investments in the electric grid and also in communication fiber. We had the announcement of the expiration of tax credits for renewables that will start in 2027, and that also created a rush to have solar projects built as soon as possible. And that's one of the services that Primoris provides. Primoris also benefited from improved margins from MSA, which is the type of work they provide to utility customers. And they are now seeing a real big, sharp increase in demand for natural gas generation, power generation infrastructure, which it's their expertise. There is no sign of a slowdown in the electricity demand, so I believe the Primoris will continue to do well. In the bottom part, we have Casella. Casella is our small cap waste management company. They underperform despite exceeding estimates. The company performed a variety of acquisitions that proved a little bit dilutive at first, whether that is because of trucks are not doing great, they're probably old and not up to standards, and billing systems as well. So they're going through some updates, getting the trucks. It has been a little challenging to get new trucks, but bigger companies such as Waste Management is already getting trucks, so I expect that to improve for Casella as well. Now, with the expansion, they also lost a little bit of the route density, which requires trucks to go a little bit further, drive longer distances, and that creates a little bit of an inefficiency right there. Other than that, I think the company has a very unique landfill position in the northeast part of the country. So as soon as they get all of these addressed, they probably will benefit from that position in the landfills in the medium term.
Okay, and to round out the bottom performers, WillScot Holdings, a provider of modular storage and temporary office space, really been hurt by a decline in commercial construction. That's, by far their largest end market. Really don't see that improving anytime soon, and that's actually a position that we've exited here early in the third quarter. And then Simply Good Foods, they have two brands, OWYN, Owen, or Only What You Need, and Quest that are growing nicely, and then the Atkins brand is struggling. And Atkins is still sizable enough that it weighs down the overall growth profile of the business. Again, don't really see how they are going to turn that around, and that's another name that we've actually exited here early in the third quarter.
So a few new names that we added. Cytokinetics is a supplier of a drug called aficamten. This is a next generation treatment for hypertrophic cardiomyopathy, basically a thickening of the heart. There is a drug on the market today, the sort of first generation called Camzyos from Bristol Myers. We think this is a much better drug, lower safety profile, and it'll have an easier monitoring program. So stock surged late in August, right after we bought it. Weird timing certainly helps, but they had some positive trial results that showed that aficamten outperformed the current first-line treatment, which are just generic beta blockers. So it was actually quite a surprise to many people there. We do expect FDA approval here in December, with additional launches in China and Europe over the next few quarters. As I mentioned, Upstart. So Upstart is a fintech firm. They take AI and proprietary algorithms and they utilize that to approve consumer loans faster, but also with better loan loss performance. So they're able to better predict what the consumer, if the consumer is going to pay the loan back, pure and simple. So companies growing rapidly, on track, generate over $1 billion revenue and positive EPS here in 2025. They do a lot of partnering with smaller financial institutions that don't have that capability, smaller credit unions, things like that. But they also take on some of their loans directly. So we think it's a unique name in the consumer lending space. As I mentioned, it was a bottom contributor. Just chalk it up to odd timing.
I'll touch on a few of the companies that we bought in small cap. So within the small cap software space, which has been somewhat challenged relative to the large cap peers, what we found is companies that are very specific, what we call vertical software, has tended to do better. And so with that sort of theme in mind, we like ServiceTitan a lot. So they have software to manage the professionals in the home repair market. So think your HVAC person, plumber, electrician, when they're either trying to schedule with customers, bill them, if it's a bigger company, dispatch the actual repair person who's going to do the work. So it streamlines all that. And once that kind of software is embedded into your system, it's very sticky. It's hard to get rid of without massive disruption. So highly recurring, which makes it a lot more predictable, and retention is pretty high. And with respect to things like fixing plumbing or your electrical work, things like that, hard to find AI to replace that effort. So we like that company a lot long term. SailPoint, again, so trying to find something that was specific to what we think is the growing space. So sticking within that AI theme, I talked about this in the large cap name CrowdStrike, having these agents talk to each other, knowing who's allowed to talk to whom. Again, these are computers, not just you logging into your network. SailPoint manages a lot of that. They call it identity governance. Fancy way of saying, hey, we're going to check your ID, to check this computer or machine's ID before it accesses these systems over here. So it reduces a lot of risk associated with these AI bots and things that are being created, what they can access when, which customers or which vendors are allowed to get which data. And that is a growing space with all this AI investment that's happening and enterprises deploying AI and these bots. They have to do so thoughtfully and making sure above and beyond it actually working that they're securing their networks. And SalesPoint's a critical piece of that. Also, highly recurring subscription-based model, which we like. We did have one sale in the quarter. That was SPS Commerce. This was a company that was involved in what do you call the electric data interfacing of retailers and suppliers. After many years of holding long-term guidance, this is a company that was very reliant on M&A. I think what was happening is they either saw a slowdown, it was tougher to buy companies, they were having trouble expanding, so they lowered their long-term guidance. It had been a solid, very predictable business, but I think they were just running into some headwinds, and we saw better opportunities elsewhere. So decided to exit that position.
And I bought so I bought it as a digital promotions business that's trying to sort of shift the way that CPGs think about promos from sort of one-off loss leaders to drive trial to something that's always on, more like, programmatic marketing. They've had some success, but it's sort of the story this year was one step forward, two steps back. We do think that there's something to what they're attempting to do. It's just a level of uncertainty that we became uncomfortable with and decided to exit the position for other opportunities. And then lastly, Verona Pharma was bought out by Merck, so we exited that position as well.
Thanks, thanks, Rich. Looking at the sector weights, there is a glaring overweight in healthcare today. Probably don't expect that to persist at this level. We just had some pretty sizable successes there, which has really driven up that sector as opposed to us purposefully buying up to that kind of 43% level. Again, portfolio here. Feel free to reach out. Most of these names won't be recognizable to most people, as opposed to large cap, which tend to be. So certainly, if you want to dive into specific names, feel free to reach out. And I'm going to hand it over to Andy to take you through the large cap equity income strategy.
Thanks, Chris. So yeah, just on the return. So Q3, I thought held up pretty well. Similar issues and constraints with respect to how we perform versus the S&P. Just not in our recurring revenue focus, having that tech underweight, if you will, given the tech and AI drove a lot of the returns. But in the broader space, we look versus the Russell 1000 value, and again, equity income, for those unfamiliar, kind of sits in between, a little bit more on the value-ish side of things. I would say more core than anything else. So I think at least for the past quarter and to some extent the longer time periods, held up quite well relative to that valuation index, given it's a slightly more conservative posture. And on the next slide, we can see how that breaks down. So if you look at total attribution of -3, most of that is just how the strategy is built. This is versus the S&P 500. Just that overweight in staples. It's really a heavy overweight in staples, driving some of that. Similar to healthcare. Again, that's more who we are, offset to some extent by positive selection effect. And then versus the Russell 1000 value, we see, as you can see, we do a little bit better on sector allocations while still maintaining a pretty decent stock selection effect. So top and bottom, I already touched on Apple and Broadcom. So the other one being Corning. Corning, probably somewhat of a household name, but they're very big in optical fibers, which is a major component in data centers. So they've benefited from that segment that saw significant growth. So the more AI data centers that get built out, we hear every day of a new company building at a new data center. All of these various servers need to be connected somehow, and a lot of that's through optical fibers. So they did pretty well in that division. They had the benefit of having a lot of that glass made here in the US, so they, to some extent, escaped some of the tariff-related issues that happened. earlier in the quarter. So they were able to uh, just get around that and manage around that a lot better than some of the hardware peers that had issues. And their outlook for the optical component business was pretty strong. On the bottom side of the ledger, I had Roper. Um, Earnings were okay, and I think the revenue guidance at the time was fine. I think a lot of this, again, so Roper is this amalgamation of a number of different kind of software businesses, and there's just been some, software has just been out of favor. So pure play SaaS is not where the market is focused on, regardless of how you're doing. And if you're not honed in on being AI centric, you kind of get left behind. That was to some extent Roper's problem, and one of their biggest businesses is software that's used by utilities. Again, nice, steady, cash flowing business, but doesn't excite people when everyone's talking about trillions being spent on AI data centers. So that was part of their issue. Um, we still like it, but something we're going to monitor as to how each individual segment within Roper is managing through some of these headwinds as the market kind of shifts its focus elsewhere. And then I'll pass it on to I guess Richard to talk about some of his names.
Yeah, so I hit on Church and Colgate previously. The only other name in there would be McCormick. So McCormick, the spice and condiments company, has actually been growing relatively well compared to other food company peers. Spices and condiments go on fresh food that people are buying in the perimeter of the store and cooking themselves to save money. That's a trend that's been helping them grow volumes. What hurt McCormick is they have pretty significant exposure to tariffs. They source from 170 different countries. There's some stuff that can only be grown in those specific countries. Um, you know, there's not a ton that you can do about that, unfortunately. And it was also a question of sentiment where, defensive consumer staples names were really just out of favor during this particular quarter.
As a top performer, we have Packaging Corporation of America. This is the third largest paper packaging producer in the U.S. They reported a pretty strong quarter. The company is taking market share away from its competitors, which chose to adopt a price over volume strategy. And in exchange, Packaging Corporation of America is opening new box plants, paper box plants, and increasing volume. All that backed by customer contracts. They are also seeing some decline in major input costs such as fiber, while they're also increasing prices, which was very accretive to margins during the quarter. Um, I think there's been a lot of changes in the paper packaging industry where you're seeing some softening demands, but also accompanied with equal or even greater decline in the supply. So, which I think will continue to be beneficial on the price side. And for that reason, I think the Packaging Corporation of America would emerge as one of the winners in the paper packaging industry.
I'll just lastly touch on a couple of the healthcare names. Johnson Johnson, company doing well. Not astronomical type of growth, but good steady growth. Darzalex in the drug side is the leading drug in multiple myeloma, and it just continues to grow at a very rapid rate. Also, it looks like that it will be exempt from Medicare price negotiation coming up due to its orphan drug status. So that was a definite positive. But no complaints. They're doing nice work over there. On the downside, Zoetis still growing nicely. Pet care, pet medicines certainly are needed. They do have a newer drug in the U.S., which is for osteoarthritis for dogs. Uh, Probably at the beginning part of 2025, there was some controversy around whether the side effects were causing deaths in some of these older, sicker dogs. Spooked some people. The reality is they don't see any of that showing up in their data, but it has been a little bit of a headwind to growth in this country. So they grew quite rapidly in Europe a couple of years ago. Came to the U.S. off to a good start, but then has kind of flatlined. They do have a next generation version of this drug in the works that will last longer, and then they're going to try and get some better data or more data around safety to try and calm people's fears. So we think that they'll eventually, plow through this, but it was certainly a drag on the stock last quarter.
In Q3, we bought Expand Energy, which is the largest natural gas producer in the U.S. They have two strategic positions, one in the Haynesville, which is the south of the U.S., closer to the LNG export terminals, and also close to the data center expansion that we are seeing in the Louisiana and Texas states. And they also have a position in the Marcellus basins, which is in the northeast part of the country, which we are seeing enormous demand for natural gas from data centers and also the conversion of coal plants into natural gas plants. What's interesting about the natural gas dynamics right now is that we are seeing the price of oil come down quite significantly, and that discourages oil producers to drill for oil, to produce more oil. And we know that natural gas is a portion of it, a pretty significant portion of it, is a byproduct of oil production. So once you reduce oil production, you also reduce natural gas. Demand increasing, supply decreasing. The obvious outcome is for prices to increase, and that will be a big benefit to Expand Energy. And that's the reason why we added it.
So, kind of a similar story. You can see our overweight in tech relative to the value index is quite large, but still below where we are versus the S&P. And then we're overweight healthcare and staples, which is really kind of our AMI, part of our overall AMI philosophy, because that's where a lot of the recurring revenue is, and where we get that ballast, if you will. And then the big difference between us, the equity income strategy, and the value, the Russell value, is in financials. We kind of steer clear from a lot of the bigger banks. We do own a few, certainly not as many as the index. And then we have some of the more sort of business, so asset management companies in there as part of our holding. And here's the list of stocks. So, some overlap with large cap, but lots of unique names that are more income friendly, if you will. And if anything is curious to anyone, feel free to reach out. I'm happy to discuss these further.
So lastly, just to wrap it up, thanks, Andy. We're somewhat cautious on the markets and the economy. Market's an all-time high. Economy is weakening. I think AI is really going to be a game changer long term. We do have some concerns, and there certainly has things have bubbled up, no pun intended, as of late. Concerning what Andy talked about, some of the circular financing relationships. So we are taking a somewhat cautious approach there, but we do think it is definitely a lot of things happening in that space. So accordingly, looking for companies with some downside protection in case things do get weak. But we are looking for growth companies, and we want to maintain that balance. And with that, we're going to wrap up, and thank you all for joining.